In the summer of 1998, a single phone call sent shockwaves through the corridors of power on Wall Street and in Washington. The caller was John Meriwether, a legendary trader and the founder of long-term capital management. His message? His hedge fund, once the envy of the financial world, was on the brink of collapse. Within hours, the titans of finance would be scrambling to prevent a catastrophe that threatened to bring down the entire global financial system. This is the story of how a group of geniuses nearly broke Wall Street. Welcome to CEO's Library, the 1% bookshelf. I'm your host, and today we're diving into the fascinating and cautionary tale of long-term capital management, as told in Roger Lowenstein's book, When Genius Failed, The Rise and Fall of Long-Term Capital Management. Imagine a hedge fund so sophisticated, so seemingly foolproof, that it attracted not only the brightest minds on Wall Street, but also Nobel Prize-winning economists. A fund that promised steady returns with minimal risk, using complex mathematical models to exploit tiny pricing discrepancies in financial markets. This was long-term capital management, or LTCM, and for a few years in the mid-1990s, it seemed to have cracked the code of modern finance. At the helm of LTCM was John Meriwether, a charismatic and brilliant trader who had made his name at Salomon Brothers. Meriwether was known for his ability to spot market inefficiencies and his knack for recruiting top talent. When he founded LTCM in 1994, he assembled a dream team of traders and academics that read like a who's who of the financial world. Among the luminaries Meriwether brought on board were Robert Merton and Myron Scholes, two economists who would go on to win the Nobel Prize in economics for their work on pricing options. Their theories formed the backbone of LTCM's trading strategies. Merton, with his concept of continuous time finance, believed that markets behaved in smooth, predictable patterns that could be modeled mathematically. Scholes, co-creator of the famous Black-Scholes options pricing model, brought a deep understanding of how to value complex financial instruments. The team also included other brilliant minds like Eric Rosenfeld, a former Harvard professor, and Lawrence Hillenbrand, a math prodigy who had been one of Meriwether's top traders at Salomon. These men weren't just smart. They were the kind of smart that made other smart people feel inadequate. They spoke in a language of Greek letters and differential equations that was incomprehensible to most on Wall Street. LTCM's strategy was based on the idea of convergence trades. They would identify pairs of securities that they believed were mispriced relative to each other. For example, they might buy an off-the-run treasury bond while shorting an on-the-run treasury of similar maturity. The difference in price between these nearly identical securities was usually tiny, perhaps just a few cents on the dollar. But LTCM believed that over time, these prices would converge and they could profit from the difference. The key to making this strategy work was leverage, and lots of it. LTCM would borrow heavily to amplify their bets, sometimes leveraging their capital by 30 to 1 or even more. This meant that even small price movements could lead to enormous profits or devastating losses. At first, the results were spectacular. In its first 2 years of operation, LTCM returned 43% and 41% after fees. These weren't just good numbers. They were astounding, especially considering the perceived low risk of their strategy. Investors clamored to get in, and LTCM's capital swelled to $7 billion by 1997. The fund's success seemed to validate the partners' belief in their models and their own brilliance. They expanded into new markets and new strategies, always guided by their faith in the power of mathematics to tame financial risk. They traded in markets around the globe, from Danish mortgages to Argentine bonds. But as LTCM grew, so did its appetite for risk. The easy profits from simple convergence trades began to dry up as other firms caught on to their strategies. To maintain their high returns, LTCM began to take on more complex trades and more leverage. By 1998, the fund had amassed positions with a notional value of over $1 trillion. The partners remained confident. Their models told them that the chance of losing everything was infinitesimally small, less likely than the Earth being destroyed by an asteroid in the next second. They had stress-tested their portfolio against all sorts of scenarios, including the 1987 stock market crash. What could possibly go wrong? As it turned out, quite a lot. In August 1998, Russia defaulted on its debt, sending shockwaves through global financial markets. This wasn't supposed to happen, at least not according to LTCM's models. Suddenly, correlations that had held steady for years broke down. Securities that were supposed to move in opposite directions started moving in the same direction, and all of them were moving against LTCM's positions. The fund began hemorrhaging money at an alarming rate. In a single day in August, LTCM lost $553 million, 15% of its capital. The partners watched in disbelief as their computer screens turned an angry red, with nearly every position losing money. As news of LTCM's troubles spread, their counterparties began to worry. Banks that had been eager to lend to LTCM just weeks before now started demanding more collateral. Some refused to trade with them altogether. The fund found itself in a classic liquidity squeeze. They needed to sell assets to raise cash, but the very act of selling was driving prices further against them. The irony was that many of LTCM's trades were still theoretically sound. Given enough time, many of their positions would likely have converged as predicted. But in the world of high finance, time is a luxury that over-leveraged firms don't have. By mid-September, LTCM was on the brink of collapse. Their capital had shrunk to less than $1 billion, and they still had over $100 billion in assets on their books. The leverage ratio was now over 100 to 1, a level that was simply unsustainable. The partners, once so confident in their abilities, were now desperately trying to raise capital to keep the fund afloat. They approached Warren Buffett, George Soros, and other deep-pocketed investors, but no one was willing to throw good money after bad. As LTCM teetered on the edge of bankruptcy, fear gripped Wall Street. The fund had trading relationships with virtually every major bank and broker-dealer. If it went down, it could set off a chain reaction of failures across the financial system. This was the scenario that brought the Federal Reserve into the picture. On September 23, 1998, the New York Fed convened a meeting of the heads of major Wall Street firms. The message was clear. LTCM was too big to fail, and the banks needed to organize a bailout. After intense negotiations, a consortium of 14 banks agreed to inject $3.6 billion into LTCM in exchange for 90% of the fund's equity. The partners, who had once been worth hundreds of millions of dollars each, were left with almost nothing. The bailout prevented an immediate meltdown, but it raised troubling questions about moral hazard and the role of regulators in financial markets. Had the Fed overstepped its bounds by orchestrating a private bailout? Would this encourage even more reckless behavior in the future? In the aftermath of LTCM's collapse, there was much soul-searching on Wall Street and in academia. How could a fund run by such brilliant minds, using such sophisticated models, have failed so spectacularly? Part of the answer lies in the limitations of mathematical models themselves. LTCM's models were based on historical data and assumed that the future would resemble the past. They couldn't, account for black swan events like the Russian default that could upend all their carefully laid plans. Moreover, the models assumed that markets were rational and efficient, always tending towards equilibrium. But as the economist John Maynard Keynes famously observed, the market can remain irrational longer than you can remain solvent. LTCM found this out the hard way. Another factor was the human element. Despite their genius, or perhaps because of it, the partners of LTCM had fallen victim to hubris. They believed so strongly in their models and their own abilities that they ignored warning signs and took on ever-increasing levels of risk. The collapse of LTCM also exposed the dangers of excessive leverage in the financial system. When things are going well, leverage can amplify returns. But when markets turn, it can lead to rapid, catastrophic losses. Perhaps most importantly, LTCM's failure highlighted the interconnectedness of modern financial markets. In a globalized economy, a default in Russia could lead to a hedge fund collapse in Connecticut, which in turn could threaten the entire global financial system. In the years following LTCM's demise, many hoped that the lessons of the episode had been learned. Regulators talked about the need for better risk management and increased transparency in financial markets. Banks promised to be more careful about their exposures to hedge funds. Yet, just a decade later, the global financial crisis of 2008 would echo many of the same themes: over-leveraged institutions, over-reliance on flawed models, and a failure to appreciate systemic risk. It seemed that the cautionary tale of LTCM had been forgotten all too quickly. So, what can we, as investors and citizens, take away from the story of long-term capital management? First, it's a reminder of the dangers of overconfidence. No matter how smart you are or how sophisticated your models, the markets can always surprise you. Humility is a virtue in investing as in life. Second, it underscores the importance of liquidity and the risks of excessive leverage. As LTCM discovered, being right in the long term doesn't help if you can't survive the short term. Third, it highlights the limitations of quantitative models in finance. While mathematical models can be powerful tools, they are not crystal balls. They are based on assumptions that may not hold in times of crisis. Fourth, it demonstrates the potential for systemic risk in interconnected financial markets. What happens in one corner of the financial world can have far-reaching consequences. Finally, the LTCM episode raises important questions about regulation and moral hazard in financial markets. How do we balance the need for free markets with the need to protect the broader economy from the excesses of a few? These are not easy questions, and they don't have simple answers, but they are questions that we must continue to grapple with as our financial systems become ever more complex and interconnected. As we conclude our exploration of When Genius Failed, I'm reminded of a quote from the physicist Richard Feynman. The first principle is that you must not fool yourself, and you are the easiest person to fool. The partners of long-term capital management were some of the smartest people in finance, but in the end, they fooled themselves into believing they had conquered risk. Their story serves as a powerful reminder that, in the world of finance, as in life, there are no guarantees. Markets can be unpredictable, models can fail, and even geniuses can make mistakes. The key is to recognize our own limitations, stay humble, and always be prepared for the unexpected. I hope you found this deep dive into the rise and fall of long-term capital management both enlightening and thought-provoking. If you'd like to explore this topic further, I highly recommend picking up a copy of Roger Lowenstein's When Genius Failed. It's a gripping read that offers valuable insights into the world of high finance and the dangers of hubris. Remember, you can find the full transcript of this episode, along with additional resources and visualizations, on our website at ceoslibrary.com. And if you enjoyed this podcast, please don't forget to subscribe, rate, and review us on your favorite podcast platform. Until next time, this is CEO's Library, the 1% bookshelf, reminding you that in the world of investing, sometimes the wisest move is to know what you don't know. Stay curious, stay humble, and keep learning.